Welcome to the Neural Implant Podcast, where we talk with the people behind the current events and breakthroughs in brain implants in an understandable way, helping bring together various fields involved in neuroprosthetics. Here is your host, Laden Yurachek.
Hello, everyone. Welcome to the Neural Implant Podcast. Today's guest is Suraj Mudichintala, and he is a senior associate at Action Potential Venture Capital, and they invest in bioelectronic medicines, neurotechnology. We'll get into this a little bit more, but Suraj, pleasure to have you on the show. I've been looking to talk to somebody from Action Potential for a while, and I'm really excited to do so. So do you want to introduce yourself better than I just did?
Yeah, sure. Thank you. And thank you so much for having me, Don. It's a real pleasure to meet you. And I've been looking forward to the conversation as well. I've had a chance to listen to some of your interviews and really enjoyed them. Yeah, I think you covered the introduction pretty well in terms of my background, predominantly a business background. Started my career in consulting, then worked at Arboretum Ventures for about three and a half years. And just recently joined the Action Potential team here based in Campbell, California, about 6-7 months ago now.
That's really cool. So do you want to talk about Action Potential, what it is, who it was formed by, and the investment thesis?
Yeah, sure. Happy to get into that. I think it was 2013 or around 2013, 2014 when Action Potential was formed, and actually it was formed within GlaxoSmithKline, the big pharma company, GSK. And the whole idea was to have this initiative or this push to start investing in bioelectronic medicines as a new area to expand beyond typical kind of drug markets that GSK had played in. And so they really started two initiatives. One was Galvani, which eventually spun out and formed its own company. And the second was to approach the same kind of thesis in bioelectronic medicines through ventures. And so they formed Action Potential Venture Capital and brought on Juan Pablo, as well as Imran Eba, who was originally in GSK in the BD function as well. And so together they made their first kind of marquee investment in SetPoint Medical, and then have since been investing in the space and really have helped grow the space really over the past 10 years. And I think maybe looking beyond bioelectronic medicine, I think the scope itself has expanded to away from traditional stimulating a nerve to achieve therapeutic effect and starting to look at a variety of different energy modalities beyond electricity, whether that's RF or therapeutic ultrasound, et cetera. And happy to talk about that expansion as well.
Yeah, interesting. And basically, it was probably just the two of them for a while. And then you came on recently as well and are expanding this investment thesis. This is something that I had heard is moving away from the neuromodulation, electrons and firing and stuff like this. But yeah, do you want to talk about maybe what prompted this move away from, I guess, traditional bioelectronic medicine into more kind of a broader category of medical implants, or I don't know, what would you call it?
Yeah, we call it energy-based medicine. And I would hesitate to say that we're moving away from neuromodulation. I think certainly that is still very much a core focus for us, and we still see opportunities in the traditional neuromod space. I think the expansion has been more about just the fact that we're seeing a lot of tangential markets with similar overlap where we think we could still be a value add in terms of both our expertise in tracking neuromodulation as well as some of the ties that we have with GSK and just their general experience. And then I think even beyond that, the latest investment we made was in a company called OnkAI, actually even a step further away from energy-based medicine, where it's essentially an AI ML-based software company that is providing a novel radiomic biomarker to determine whether or not a patient would be responsive to IO therapy or IO therapy plus chemotherapy in non-small cell lung cancer. And the thesis behind that being more looking at novel biomarkers as they relate to giving pharma companies a better what we call an unfair R&D advantage as they look to develop pharma assets, as well as providing better precision diagnosis at the time of treatment for oncology patients as well. That's probably the most recent step away from the traditional thesis, but I would say we're seeing plenty of opportunity in all of that broad category of spaces and continue to be active in all three.
Yeah, that's really cool. Okay, I want to talk a little bit about venture capital, maybe, I guess, the history or kind of the basics of it. You guys were founded by GSK. Does that mean the bulk of your money comes from there? Do you want to talk about like partners, limited partners, all this? And where does your guys' money come from, or where does it typically come from?
Sure. Yeah. So traditional venture capital firms, as you have an LP base, a variety of asset managers, our fund is different in that we invest actually directly off of GSK's balance sheet. So what's called an evergreen fund, where we don't actually have a fund size. Typically here at venture capitalists say we're investing out of $100 million fund, et cetera. And we don't have that structure in place. And our sole LP is GSK. So in terms of what that means in terms of our differences from traditional VCs, one is we don't have to fundraise in the traditional methods that most VCs do. And that takes up a lot of time. And I'm sure you've heard around that raising right now for VCs is very challenging given the down markets and the lack of liquidity some of the larger asset managers are facing. In times like this, it really is what we see as a real strength to our firm. That being said, we do have to operate. We're technically a subsidiary of GSK, fully owned by GSK. And so we do operate by a strict kind of annual budget, kind of forecasting how much cash flow we're going to set out for the year, et cetera. So it's a little bit different, but I think from the perspective of a startup, there's really not much of a huge difference between our fund and a more traditional venture capital firm.
Yeah, I've heard that it's well known that when you have a company and you're trying to get startup funds, investment funds, it's very difficult. But I heard that venture capital money raising is 10 times harder than that. And so the fact that you guys don't have to deal with that, I think is a big benefit, because most other VC funds, they have to spend, I think it's about a third of their time actually fundraising and only about 2/3 deploying capital, something like that. So basically this frees up a lot of space for you guys. I want to talk about positions within a VC firm, and how does this work? How is this kind of structured, and associate principal and a partner, all this kind of stuff?
Sure. Yeah. So analysts typically have maybe 1 or 2 years of experience. That's the position that I started at my prior firm. They're typically involved with assessing inbound opportunities. And some venture funds have a more of an outbound strategy in terms of reaching out to startups that may be of interest. So that would also fall under the analyst purview. I think it's really a little bit more of an operational role, but still having exposure to the conversations and developing a thesis, et cetera. I think at the senior associate level, you're really starting to lead a lot of the diligence efforts alongside a partner. Deal teams are typically quite small. You'll have a partner and maybe one associate is the typical team. And associates and senior associates build the diligence decks and the diligence materials to present to the investment committee, typically have more of an influence on developing a thesis, et cetera. Once you get to the principal and partner level, that's the level where have your name on the check, right? So you're the one that's actually deploying the capital from the fund. And so you would get attributed to the success or the failure, or however you want to phrase it, the returns that you generate based on the money that you put out. So that's really the main difference. The way that I think of it is really everything below the partner level, you have the same function in terms of developing a thesis. And I'm happy to talk a little bit more about that. Yeah, that's probably the summary.
Yeah, that is interesting, because you've gone from basically analyst to associate now. So I was curious, how has your work changed or life changed or something like this? Are you doing less of the grunt work and a little bit more the high level stuff, or what's the difference there?
Yeah, I would say that's probably true. I would say more importantly than that is that I probably have more of an influence on kind of the internal discussions, more of a voice on the team. And I know that sounds a little nebulous, but I think it is meaningful, especially at a team like Action Potential, where there's really only three of us, two partners and myself. Borrowing from my experience from Arboretum and having looked at a number of different markets outside of bioelectronic medicines, I think some of my perspective is really valued here. And really, that's what you would hope for and expect as you elevate through any organization.
Maybe picking up less dry cleaning and a little bit more, I don't know, time at the office, something like that.
Yep.
That's funny. Yeah. Okay, great. That's interesting. Okay. How does you were talking about diligence decks, and you guys obviously have to do due diligence. A company comes, pitches to you, you say you like them. What does that process look like? What are you doing in that? And maybe what are some, I don't know, common pitfalls to avoid in this?
Sure. The process is pretty straightforward. First, we would hear a pitch from a startup. Typically, that would get a warm introduction from someone in our network. Once we hear that pitch, we have an internal discussion as to what we thought. We see there's real opportunity here. And if there is, I would say we get into the first layer of diligence, which is, and typically in that first pitch meeting, we all tend to hone in on one or two key focus areas or issues that we could see arise in the business long term. And so we would focus our initial diligence on making sure we can tackle those questions. And what does that mean? It could be a variety of things, right? So, for example, if it's a small, questions on the size of the market and therefore the larger business opportunity, that would probably involve a little bit more of a secondary effort where I would probably go and do the research online or look for reports or do primary research to understand how big is the opportunity really. If it's more of a question of business need and whether there's truly an unmet business need in that specific and what that startup is looking to tackle, we would kick off maybe a primary interview campaign where we would maybe interview a handful of physicians, KOLs, et cetera, to understand whether or not a technology could fulfill that unmet need if there was an unmet need, right? So that would, I would say, be the first step of diligence. And then it really progresses through there, especially in the medical device space. There's a lot of things we need to check off: regulatory, reimbursement, understand the coding pathways, payment levels, et cetera. And it's a little bit hard to be so specific because every company is very different, as you know. But I think if we get to a point where we're comfortable and get positive on the investment, we would put together a term sheet in which we would value the company at a certain pre-money valuation. And that valuation is often determined by whether or not our fully diluted ownership at that given level would still give us venture-like returns, meaning that 5x plus range upon an exit of an investment, forecasting in future cash needs, future raises, et cetera. So once that term sheet is submitted, assuming that the company were to accept the terms, we would then go into the kind of the deeper layer of diligence where we would do corporate diligence, IP diligence. We'd probably bring on a couple consultants to do that, counsel, investor counsel, et cetera, and syndicate the deal with other investors. As APVC, typically we lead deals. And once all of those diligence buckets are complete, we would complete the company formation, the investment documents. And once that is all agreed upon, we would wire funds and the deal would be closed and we would go from there.
Yeah, very cool. Thanks for taking us through the process. I think that's very fascinating stuff. So basically, a lot of VCs have target size range, be it seed or angel or maybe larger institutional stuff. But it sounds like you guys don't really have that. You just want to hit that venture capital return, the 5x that you had mentioned. Is that correct?
Yeah, exactly. I think so. We've seeded companies in the past, and we've also done growth rounds, much larger rounds of capital. I think the way to think about it is that if you are taking on early product development risk along with all the other risks that follow, you probably have a much higher threshold for your returns, given your risk adjusted returns are probably a bit lower than whatever you're forecasting, given all those risks. Whereas if you're investing in a company that's already commercial, you may have a lower threshold, right? You may be looking more for like 2x or 3x on your capital invested, given that there's already a product on the market.
Okay, so how did you get into this? You started as an analyst out of school, right? How did you get into this space?
Yeah, it's a good question. It's pretty, yeah, I'm laughing because it is a very niche space. But I actually started my career at allocate Consulting, which is a management consulting firm. And I was there for about 2 years, and that gave me what I would call like the fundamental toolkit of analyzing a business, right? Kind of, yeah, I was able to lead a lot of primary research initiatives for our clients, learned how to ask the right questions about a business, learned how to analyze a business's financials, learned how to look at a market size, competitive dynamics, et cetera, to see where there were gaps and where a company could potentially develop a product. And so with all those skills, despite the fact that I was looking at a multitude of different industries, I was able to hone in on maybe I could be really valuable at a venture capital firm. I wasn't totally satisfied with my consulting job at the time. And so I decided to start looking into venture capital. And I also through my cases at LEK, had a lot of exposure to the healthcare space and reached out through a headhunter to Arboretum for their analyst role. And so I was a pretty good fit given both my healthcare experience, et cetera, and joined them. And then I guess to the second part would be, while I was at Arboretum, I looked at a multitude of different healthcare spaces, healthcare IT, digital health, life science tools, et cetera. But really was able to get involved with a couple of our neuromodulation deals at that fund, and was able to really garner an interest in therapeutic medical devices that were pushing the technology frontier And I linked up with Action Potential because I felt really excited about some of their portfolio companies and just the way that they had built their thesis over time.
Yeah, that's pretty cool. It's interesting that you used a headhunter because usually I think of that as like a later stage thing, and when you're got gray hairs and everything like this, that's when they come knocking. But it's interesting that worked. And then consulting is thought as a very high stress, high paced environment. 1 year of experience in consulting is almost like 5 years in the business because you're always going out putting out fires. So how does that compare to the VC life? Is it much more relaxed? Are you finally able to sleep now, or what are pros and cons of both?
Yeah, that's a great question. I would say the consulting role is, you're right, it can be stressful. I think LEK in particular was stressful because of the short turnaround time of our cases, where we had, in my 2 years there, I did about 20 cases, which is very atypical for a consulting firm. But anyways, so the reason consulting can be challenging is it faces the similar has the similar traits of any kind of client-facing business, whether it's being a lawyer or being an investment banker, et cetera, where you're always at the whim of various clients. And oftentimes, if a client asks for something, the client's always right. It's like the customer is always right. And because of all of those factors, it was a very intense job. I was probably working close to 12 hours a day. Oftentimes, it would break out as doing primary research, interviewing KOLs in the beginning half of the day, and then synthesizing those interviews and then writing a deck and kind of presenting that the next day in the latter half of the day. And so, anyways, relative to VC, I think VC is very different, where you're not actually being, the way that I think about it is that a VC is really paid to allocate capital, but really is really paid to think, right? You really have to think about what is the next space or the next technology that could disrupt a space. And because of that, you often have to take a much more longitudinal view, right? And I think it takes a lot of patience and tracking a space oftentimes for years. And so because you're not really serving a client so much as you are distributing capital and allocating capital, managing the day-to-day schedule is definitely, I would say, a lot easier. The stresses are a little bit different though, right? I think while the day-to-day might be easier, the ability to be successful is, I would say, much harder because there's so much unpredictability in the business, right? You're investing often in early stage companies that in some cases could be pre-product, right? And so for you to really make a $5 million bet on something that's pre-product, that takes a lot of guts, frankly. And living with the stresses and the ups and downs of a startup, you have to develop even keel personality because challenges always arise and things always go wrong. But again, it's a different level of stress. I would say the partners that I've worked with in the past definitely have had sleepless nights, whether it's in Arboretum or APVC, but in consulting, they've had sleepless nights because they're working on putting materials together all night. So it's just at different levels.
Yeah, maybe what I'm hearing is the feedback cycle is much longer in VC. So you don't really get good feedback as to if you're doing a good job versus in consulting, you're maybe getting feedback within a month or something like this. VC, it might take a few years to be like, okay, did you do a good job or not? And so it sounds kind of like a long-term thing. So I guess if we translated, you did the 20 cases in 2 years over at a consulting firm, but how many cases have you done both in Arboretum Ventures and now Action Potential? What's the conversion, I guess?
Yeah, probably can't answer that. I honestly haven't even counted how many investments I've been a part of the diligence process of. I know at Arboretum, I was definitely more than 10. I was really helped in the diligence process for a lot of the Fund 5's deployment. At APVC, obviously, I've only helped do the diligence on the one company we invested in a couple months ago. I don't know. That's a tough question. I can't translate that for you.
But I think that is actually useful because you were at Arboretum for 3.5 years, something like this. And if you did 10 there versus 20, and I don't know, so there's maybe like 2-3 times less, something like that. I think that is useful. Okay, so you mentioned if a company wants to reach out to you, they should get a warm introduction. Basically, they already need to know somebody. They already need to know you guys to get the introduction. So this sounds like a little bit of a chicken and egg problem. Like, how does a company get your attention? Because your LinkedIn is probably a mess, right? Like you have thousands of people writing you or something like this, asking for money. So how does that work, and what would you suggest is the best way to get attention?
Yeah, I think the best way, of course, we're talking about conferences before we started the podcast. I think the one way is to meet someone in person, get their attention for a few minutes and try to, whether it's an elevator pitch or whether it's just talking to them and having a nice conversation, that's one way. The best way is probably by going through people in your circle that happen to be already connected to a VC. And I think what ends up happening is, for example, if you get connected to one VC, but that VC maybe for space or stage or et cetera, may not be interested in working with you, they'll often have a circle of VCs that they can then refer your business to as well. I think it's important to take advantage of the networks that you have. For example, one that I see often is Boston College alumni or different college alumni, et cetera. So definitely try to use that. But otherwise, I think it's just being as active as possible, meeting as many people as possible, but also making sure that the interactions that you do have with the folks that you're meeting with, regardless of whether they're an analyst or a partner or whatever, are positive interactions. I've also had people reach out to me once and I might tell them, hey, this isn't for us. And then they may reach out 5 or 6 more times after that. And all of a sudden, the likelihood that I would ever refer them to anyone or have a positive impression of them is not great. Persistence is good, but persistence to the point of being overbearing is probably not a smart strategy, right? So finding a fine line and trying to use the networks that are at your disposal is probably just the best way to go about it.
Yeah, that's pretty cool. That's good advice. And we met at the Neurotech Leaders Forum in San Francisco, put on by Neurotech Reports, Jim Cavuto. And I think that's something like that is really cool because you can get in front of, like you said, investors and meet them and have lunch together or drinks together. So I think that's really cool. What are okay, so this is audio only podcast, but we have video right now and I see you're wearing a hoodie, but I thought all VCs wore sweater vests. So what other, I don't know, stereotypes about VCs aren't true?
What stereotypes about VCs aren't true? Man, give me some stereotypes of VCs maybe that you have in mind, and I'll tell you if they're true or not. How about that?
That's the big one, is the sweater vest. Especially in the Bay Area.
Sweater vests.
Yeah.
Yeah, I would say that one's definitely true. I definitely see a lot of VCs in sweater vests. I would say a lot of like finance, what's considered finance, bro, attire. No, I think VCs, I'm trying to think of other. Like, for example, the one that I heard is, a VC, if they're not interested, will always just say, oh, you're too early for me, or you're too early stage. And that's like an easy way to say no. I think that can be true, but I think if you're getting a sense that someone's doing that, maybe you don't want to be a business partner with them in the first place. Maybe you want someone who's more thoughtful about your business. I think so that could be one stereotype. I don't know. What else have you heard?
Yeah, I guess you said finance bros. Is it mostly men that do this? And do you think there's a reason that more men are attracted to it?
So I think yes, I think it is a male-dominated industry. I think it's a white-dominated industry as well. And diversity, equity, and inclusion is certainly a big topic amongst our industry now. Why is it like that? Why is it predominantly white men and men in general? I'll start with, I think, probably access to the industry is one, right? I was reading a report that was done by the Bureau of Labor that said that the entire innovation ecosystem over the last 20 years has been 90% white male. And if you think about that, going back 20 years, it's a little bit of, you just don't have the connections to start off and get introduced to the industry unless you're at these kind of either elite programs or have exposure to like an elite circle or network. And, I remember one time I was tutoring and volunteering at a high school, and it was a predominantly African-American high school, and most of the kids there had no idea what venture capital was. They didn't know much about finance, right? Whereas if you go to these prep schools, et cetera, they often will even teach you about some of these things, right? So I think it goes in line with the broader trends of education access, et cetera. If you're asking why are men more interested in venture capital, I don't actually know if that's the case. I don't have sufficient data to say that's the case. Stereotypically, maybe observationally, that might be the case. I think women know for a fact that there's been a big push to get more female kind of demographics in our industry, and that goes to the entire innovation ecosystem. And so the short answer is I don't know if I would say that men are more interested than women in VC.
Yeah, no, that is interesting. And I guess this kind of goes back to what we were talking about before, is you want the warm introduction. And so you already have to be plugged into it a little bit to do that. Yeah. And some people, it's not even on their radar. Some groups of people, it's not even on their radar as something that is possible. But Yeah. Okay. So you presumably have lots of people trying to reach out to you. What are some tips and tricks? What are some things you hate? What are some things you love? And yeah, what's some best practices?
Yeah, I think having so when you reach out to a VC, having a pitch, first of all, sending a non-confidential pitch deck is mandatory, I think. And that deck is essentially where we're making the first decision as to whether or not to do a call with you. So I think the most important things to me when I look at a deck are, one, is there truly an unmet clinical need? And if that doesn't come through, I think that is more often than not the way that we would filter a company out of taking that first call. If that is the case, then it's a question of, is this something that there are a number of technology solutions for already? How competitive is the market, et cetera? I would look at how much capital they're raising and how much capital they've already raised, because that gives me some indication of what the valuation is going to be. And with regard to the entire overall market opportunity, that gives me some sense of venture metrics, whether we could get a venture-backed return, a venture-sized return on making an investment in the company. And then I would look at kind of some of the more go-to-market challenges our entire medical device industry faces. What's the regulatory pathway? Is this the 7 to 8 year PMA? Or are we looking at a 510K? Is this even maybe it's an unregulated product, et cetera? And then lastly, of course, look at reimbursement. Does the company need to develop their own unique billing code? Are there codes already in existence? What's the likely payment level? And is this, again, going back to the unmet need question, will this company be able to get a payment level that's sufficient to sustain a kind of high margin business that could drive that exit? There's a number of questions under each of those kind of categories, but the bottom line is, of all those categories, you want very succinct answers to all of those things in your deck. And you probably want your deck to be very, not super short, but maybe 10 to 15 slides. So it gets to the point, right? I think one of the great pieces of advice one of my former mentors gave me was that writing a 20 to 30 page paper is often much easier than writing a 5-page paper, because the level of, you have to be a lot more articulated and specific with your words and careful with what you say if you shorten the length. And so I really like seeing concise decks that get to the point.
Yeah, that's really interesting. Actually, I think that was much more common back in the olden days. I think it was George Washington that said something like he was sending his wife a letter or something like this, and he said, sorry, it was so long, I didn't have time to make it shorter. It goes along with that, and you have to be very cognizant of how you're putting it together. Yeah, that's really interesting, and I think those are very good tips. What are some horror stories, either in Action Potential or Arboretum? What to you is, oh my God, this was the worst thing I've ever seen, and I don't know, maybe the guy that wrote you 5 times or something like this, or just maybe the worst pitch deck or the worst due diligence or something that you've gone through?
Yeah, I think the funniest and also one of the worst was someone had reached out to me, and the subject line was, "This company will make you billions, if not trillions of dollars." And just don't be, if you're that, if it almost sounds a little delusional, right? Like, don't say something like that. You immediately lose all credibility. I'm trying to think of diligence, big diligence no-nos. I think luckily, I haven't faced this in any diligence process I've been in, but I've heard from other people, of entrepreneurs or founders, that have lied during the diligence process, that only to be later uncovered by corporate diligence, et cetera. That's it, for obvious reasons, a huge no-no. We would never, ever be partners with someone that's untrustworthy. And in a lot of ways, really, that's one of the most important things that we would look for. I'm trying to think what else. Yeah, I don't know. I don't think I have any like truly crazy stories, but
yeah, that's pretty funny, that the email subject. That sounds like an email that would go straight to spam, actually.
yeah.
I'm surprised you even looked at it, or I don't know if you responded to it or something like that.
No, that went that. Yeah, you don't respond to something like that, I think.
Yeah. Wow. Well, Suraj, I think this has been very informative, and I think good tips and nice background of VC and everything like this. Is there anything that we didn't talk about that you wanted to mention?
No, I think certainly to anyone that's in the bioelectronic medical device space, or to anyone that's even looking a step beyond that, whether that's energy-based medicines or novel biomarkers using software, please feel free to reach out to me. I'd love to learn more about your company. And apart from that, I think it's been a real pleasure, Ladon, and thank you so much for having me on. And yeah, thanks for everything.
Yeah, thank you. This has been great.
Hope you enjoyed the show and were able to learn something new, bringing together different fields in novel ways. Until next time on the Neural Implant Podcast.